when questions, comments, do you want me to do it in real time, or do you want to
however you want,
wait until the end?
However you want, just feel it out however you want. I'm easy with this stuff. If you're fine with it, might, chat back and forth, like a question pops in or somebody, every once in a while I'll stop and I'll say, right, does everybody understand that? And maybe something pops in, but I'm usually fairly interactive, but I can do it either way.
Okay. Then we'll just feel it out, especially because if it's a timely comment or question right with the point you're making, then it just makes sense to do it right then. So, usually if you don't have a problem getting interrupted, then, and they do it properly, I think. So,
yep. Nope. Sometimes the spontaneous stuff makes for the best presentation. So however you want to do it.
Okay. Sounds good. I'm trying.
I see a couple of folks popping up, so you must be doing something right.
Well, they actually registered in advance, so good for them. I'm going to figure this out real quick. I'm going to and then we add that one. I add this thing. Zoom meeting. Here we go. That's a good sign. And all right, this is the weirdest thing. It is not going through on Facebook.
Oh, you're watching.
So go figure.
Yeah. Where he talks. I don't hate anybody. Yeah.
It's a great one.
I've seen it.
That's the first time I've seen
it. Yeah. What?
You were in Blueberries.
All right. So what we're going to do for Facebook, because sometimes things just happen. You never know. I'm just going to take my YouTube feed and put it in there.
Look at you.
Take that one. And I'll throw it in here.
A sandwich?
Mm-hmm.
Just on your turkey and cheese or whatever?
Mm-hmm.
Chicken's better than turkey.
All right. Can't get the stream to Facebook right now.
There you are. You're popping up on my LinkedIn here.
Here's my YouTube link. I'm going to hit post on that one. I'm going to share to join us into the Facebook group, but not on YouTube. Already did that. I'm not doing that again. So that's how I got hacked the last time, which was really weird. Okay, so close that out. Almost done here. And then join us on Zoom here.
Yeah, you're looking good on LinkedIn here. Some ugly bald guy next to you.
Yeah, I don't know about that guy. He's a little unhinged, but
he is.
But once he brings me a brisket, we'll be all good. But
hey, we will next time.
There we go. All right. Okay, we're going to go ahead and officially start here. First of all, everybody, thank you so much for coming back. It is March 9th, 10 a.m. Pacific time, and today for our group expert series. And as you know, I try to bring some of the best minds, some of the best communicators, and we got Charlie Gipple here with us. A lot of you know that I do a lot of my life insurance business through Tom Love and the Breakaway League, but when it comes to other products and such, I like having other people who know their stuff, and Charlie's one of the sharpest minds. You're going to see that today, and one of the nice things is that it's not all that technical. Now, you got to know you're technical to back it up, but being able to communicate things using word pictures, using the whiteboard, all that stuff, that's the key of communication. I love great communicators. So you're going to see why I do my other business through Charlie, and Anyway, we're going to continue from there. So, Charlie, please, this is your show. And as I get comments, I'll interrupt you. We'll go from here. We'll have some fun.
Please do. And folks, you can chat away here as I will see the chat comments or questions that you have. Sometimes I like to keep it interactive. So I may ask you some rhetorical and not so rhetorical questions. But first and foremost, thank you guys and gals for your time in advance. David, it's always great to share the stage with you, my friend. You've built quite a thing here. I'm sure you're complimented daily, but this Pleiad, is it Pleiad or Pleiad? Pleiad group.
Plaid. We changed it to Plaid. So we make it really simple.
I like it, like the Tesla Plaid. That's the top of the line of Tesla, right? You've done a great thing. So congratulations to you, David. You are certainly a steward of our industry. If everybody was like you, it would be a great industry. And yes, I will cook you some brisket next time we see each other, like my guy Tony, my good friend Tony, who's also a member here. Folks, again, thank you for your time. Here's what we want to talk about today. First and foremost, it's not, as many of you know, if you've been in the business for some period of time, it's not what you say, it's how you say it, right? I had a mentor, and he and I about 15 years ago were presenting to an audience, and he goes up to this lady in the front row, and you've probably heard similar stories related to this here, but this is a true story. He went up to the lady in the front row and said, it's not what you say, it's how you say it, because, you know, ma'am, when I look at you, your face can stop a clock. And I'm like, what did he just say? And she's looking at him really weird. I mean, she's about to get aggressive. He says, well, what if instead of saying that, I told you that when I look at you, time stands still? He said, what I just said was the exact same thing. The exact same thing. I just said it in two completely different ways. It's not what you say, it's how you say it. And that's really what I believe in, of the probably couple thousand presentations that I've given over the last 25 years or so. That is what I learned. My entire career changed once I realized that the pictures are drawn with words. The pictures are not drawn with PowerPoints. Don't you love it when you join a presentation and the PowerPoint or the presenter is pulling up their PowerPoint slides and it says slide 1 of 328. You're like, oh man, it's nap time. This presentation's going to be horrible. So what I like to do is I like to tell stories. I like to talk about the language, and I fully understand that there are times where you need to draw pictures for your clients. But do you go into a client's house and pull up a projector and say, hey, I'm going to go through these PowerPoint slides? No, you do not. Many times you're drawing it out on a napkin, what I call napkin diagrams, right? So that is why I love my trusty whiteboard. That's kind of an inside joke. There's Charlie and his whiteboard. I love the whiteboard because there is power in the pen. When you're presenting, there is power in demonstrating to the client in real time how this stuff works. Because folks, make no mistake, I love talking about annuities and life and long-term care. Of course, life is usually the star of the show, but we're switching to annuities. But with annuities, as I'm going to talk about, there has never been a better time, a better opportunity than today to offer annuities. The math and the science works in favor of annuities. If you go out to my LinkedIn page or my profile on LinkedIn, hook up with me, connect with me on LinkedIn. I just posted this morning something about the math and the science versus the 4% rule of thumb, for example. The math and the science works when it comes to annuities. It's just, they can be a little more complicated. How do you relay the message of annuities while at the same time having the clients actually understand it? And that's what I want to talk about today. So a few different things. History of annuities. I want to go back to the Roman Empire. We'll talk a little bit about the beginning of annuities. Secondly, I want to talk about the language, conversations with clients, a couple of stories here. My good friend, Tom Hagna, he's got a couple stories here that I'll share with you, and I'll give him credit. I'll give him credit where credit is due. I'm not a plagiarist, so I'll tell you when it comes from Tom there. Also, how is a watch built? You know, you've heard the phrase before, don't tell me how the watch, I just want to know what time it is. Don't tell me how the watch is built. Well, sometimes agents, financial professionals like yourself, want to know how that watch is built, because many times you look at me and you say, yeah, Charlie, that sounds too good to be true. Ever heard that before? Seems too good to be true. Yeah, Charlie, so you mean to tell me that if the market goes up in a year, I can get possibly up to 10% in that year, but if that same market drops the next year, I don't lose one penny of my principal plus that previous year's interest? Yes, that's exactly what I'm telling you. Seems too good to be true. Tell me how it is that any insurance company on earth can do that. That's what we're going to do today. Let's see, indexes, GLWBS, indexes, caps, participation rates in a simplified, distilled down format. We're going to talk about what these things are. This is not breaking news, I know, but recent research has found that the reason consumers purchase annuities, folks, tell me in the chat pane, and I'm going to keep talking here, but just chat away with me. Tell me why you think it is that consumers purchase fixed annuities and indexed annuities. Why is it? I'll tell you one of the reasons that consumers love fixed annuities and indexed annuities is because it works as a supplement, peace of mind with income. Jeff, nice to see you, Jeff. Because it works as a supplement to their Social Security. These studies cite that that is specifically what consumers purchase, many consumers purchase these annuities for. They love their Social Security. They love their defined benefit pension plans. Why? Because they give you permission to spend. Tom Hagna, he says, here's what we do throughout our pre-retirement years. We work. We put away, some people put away money because you have dreams that once you retire, you're going to buy the lake home. You're going to buy the country club membership. You're going to rub elbows with all the big wigs in retirement, go out and entertain yourselves for the last 30 years of your life. In reality, that doesn't happen. In reality, the number one fear for retirees financially is running out of money too soon. They don't give themselves permission to spend. So as a result, they pass away with this huge war chest of money that they never got to enjoy themselves because they were pension pennies. And what do the kids do with that money at that point in time? They buy that yacht. They buy that country club membership. They buy that lake home, right? Why is that? Because they were in investments or savings vehicles that maybe did not give them the permission to spend. Defined benefit pension plans do that because if you run out 1 month, what happens the next month? You get that check again. Social Security, the same thing. Optimizing Social Security, I help a lot of clients myself as well as my agents optimize their Social Security. I'll tell you, they love their Social Security. It gives them permission to spend. What is the third way that consumers can do this? A supplement to Social Security can be annuities with GLWBs, guaranteed lifetime withdrawal benefits. So that's what I'm going to talk with you about there. And then if we have some time, get into long-term care annuities. One that is age 65 and older. Tell me, folks, what is the probability that one's going to experience a long-term care event? What is the probability that one over the age of 65 is going to experience a long-term care event? And I'll name them off as they come in, or I'll cite the statistics that pop in as they pop in. All right, so here's what we're getting. Yep, everybody's saying 70%. 7 in 10 chance over the age of 65, you will experience a long-term care event. The median cost of a nursing home in the United States today is close to $110,000 per year. Long-term care, it is one of the crises of our lifetime, which is, of course, impacted by the umbrella risk, the risk that multiplies all of these smaller risks. That is longevity. So let's go back to the history of annuities here. So it was about 50 BC, around 50 BC. This gentleman named Julius Caesar did things a little unconventionally.
I was going to say gentleman, but okay.
Yeah. A little unconventional, which I won't get into the crude details there. But what he did was he came up with this notion that, hey, if my soldiers outlive their ability to be productive in their soldier ways, here's what I'm going to do. The spoils of war that we win, all this stuff that we acquire by winning these battles, instead of just sharing it with them, instead of me taking it all, what I'm going to do is I'm going to take half of that and I'm going to give it to them in their retirement years. Retirement wasn't a thing then, but once they outlive their ability to be useful, I'm going to give them that other half of our spoils of war over their lifetimes. And that is really the notion of annuities, right? You see varying reports of how did annuities, the thought of annuities really arrive? And there are varying reports, but I tend to stick to the one with Julius Caesar. Fast forward ahead, the Great Depression, from 1929 to 1932, the stock market lost, and of course the S&P 500 wasn't a thing back then, but you can back test certain indexes to 1929. But over that period of time, 3 years, the market lost about 90% of its value, right? This annuity business, which, yes, it existed during the Great Depression, even the formal annuities, not the Julius Caesar type, they doubled in sales over that period of time. And you'll see this trend time and time again. In times of turmoil, in times of uncertainty, annuities bring certainty in those uncertain times. The annuity industry doubled. Fast forward ahead to 1995. The birth of the indexed annuity. Why were indexed annuities created? They were created because consumers in 1995 were looking around and saying, man, certificate of deposit rates, CDs, they're lousy today, right? Which is actually laughable today. They weren't lousy in 1995. But compared to the 1980s, they were lousy rates. Well, at the same time, the stock market finished on a down note in 1994, the year prior. While at the same time, what happened to the bond market in 1994? It plummeted. It imploded. It was the great bond market massacre, as I think it was Fortune magazine, right on the cover of Fortune magazine. Just Google the great bond market massacre and you'll see 1994. So what did this company called Keyport launch to the market that was, it was a big deal at the time? Maybe not such a big deal, but obviously later it became a big deal. This is a big chunk of our industry today. Indexed annuities. So what Keyport said was, hey, so instead of getting these lousy certificate of deposit rates over here, what if we gave you this? The alternative many times to this over here is you play in the stock market, you play in the bond market. That has proven to be somewhat dangerous, at least based off 1994's standards. So what if we told you that you have the ability to get more than certificates of deposit if the market should increase, while at the same time, should that market plummet, you just get a zero on your statement. You don't lose any of your money. And I don't know the exact specs of that key index, which was the name of the product back then. But essentially what an indexed annuity does is that they are designed not to beat the stock market. Breaking news, folks. The next time you see from a carrier, that illustration that shows 15% back-tested illustrated rates, they're not designed to do that. They are designed to be, Dave's laughing, they are designed to beat the bank. They are not designed to beat the stock market. And that is the birth of indexed annuities.
And Charlie, I'm going to interrupt you real quick because the ongoing performance of an index annuity can be better long-term. And the reason is not because of the interest being credited, but because of the principal protections and avoiding the downsides. And it's because of that function. So when we do talk about that, they can beat it. Yes, they can. But why? It's not the interest that's being credited. It's that you're not going backwards. You have that principal protection on the downside. So it's so important that we disclose that that's why it works that way.
Well said. And how do we show that graphically? I'm going to show you in a bit, as well as David. Yes, it's not about the amount of return on your money. It's about the amount of money you're getting the return on. With indexed annuities, it's not about getting 50%, but you know what? It may be about getting, say, 7% on top of a value that had never been eroded as a result of the prior year's market decline. That's what indexed annuities were created for. How have they done through history? Well, now it's what, like an $80 billion business? It's grown significantly. It is now one of the elephants in the room, to where back in 2008, variable annuities was the elephant in the room, right? So how did indexed annuities do through the lost decade? From 2000 to 2010, we all know this very well, especially those that had money in the market. It was chopped in half twice over that period of time. How did indexed annuities do in this time of turmoil? If you took the beginning industry-wide sales of indexed annuities, compared that to the end, you would look at a compound average growth rate of around 20%. In times of turmoil, annuities, they flourish. Fast forward to today. What happened last year? Was last year somewhat tumultuous? Was it a little bit volatile?
Nah.
Well, it wasn't if you were in the right stuff, right? The S&P 500 was down, 19.4%. The AGG, the aggregate bond index, which is a good measure, benchmark for the bond market, down 16%. So our nice little diversified 60-40 portfolio was down, 16, 17% or so. One of the worst years in the history of, the 60-40 portfolio. Nowhere was your money safe. I remember American Funds, one of my favorite mutual fund companies. I remember at the end of 2022, it was actually the beginning of 2023, just a couple months ago, looking at the list of the returns for the past year. Target date funds, bond funds, Growth Fund of America, their flagship fund. Every single one of them was red. And I thought to myself, I wonder if this has ever happened within a major fund company like that. Every single one was target date funds, 2025 target date funds, down whatever it was, 25%. Significant, right? So how did the annuity business do in 2022? It was the best year on record, the entirety of the existence of annuities, not just indexed annuities and multi-year guaranteed annuities. So these two major categories that make up the fixed annuity component, right? The best year ever. Then you have variable annuities. That's the entire annuity industry. The best year ever for annuities, period. Although the variable annuities, does anybody know what the shining star is with variable annuities today? What product line is the shining star of variable annuities today? They are technically securities, technically variable annuities, but what is the shining star that is helping prop up, so to speak, the variable annuity business, even though 2/3 of the annuity business is fixed annuities? What a flip from 2008, right? Nobody knows what the shining star is. RILAs, baby. Alyssa, I think it is, variable guarantee annuity. That's probably what Alyssa was referring to as well. But never has the time been better. Not just that. I'll tell you why I'm so excited. So I'm 45 years old and I feel fortunate. Never has there been a better time, not just in the annuity business, but in the asset gathering business, the retirement business. Why is that? The oldest baby boomer today is 77, born 1946. The youngest baby boomer is 59, born in 1964. That pig through the python, that demographic pig through the python getting older, that python has not fully digested that pig yet. So you have this huge amount of wealth, 60% of our country's wealth owned by these baby boomers that is dislodging as we speak from those 401k plans. They need help with that. Individual retirement accounts many times can be better than what they have in a 401k plan. Hitting Social Security age. They love Social Security supplements, as we talked about. That pig through the python is still happening. And by the way, young folks, which I think I'd probably consider myself kind of relatively young, even though I look like I'm about 80, I was told the other day. David, you probably made comments like that as well in the past on me. But here's what I'm excited about is those retirements that are happening. What is the average age of an agent, of your competitor in today's industry? How old do you think your competitor is on average in the insurance business? Registered reps, they're a little younger, but let's just talk the life insurance business. The last number I saw was 63. That's the last number that I saw. So think of this. You have this huge tidal wave of assets where they need your help. Your competitors are they're being taken out to pasture, so to speak, right? They're retiring. They don't want to do this. Many of them don't want to do this anymore. So think of the huge tidal wave that you have the ability to take advantage of if you just ask a couple questions. Here's one question. So Mrs. Klein, as I'm helping you with your life insurance, your long-term care, whatever, are you fairly satisfied with the rate, that $100,000 you have in a certificate of deposit? Are you fairly satisfied with the rate that you're getting on that? 9 times out of 10, although CD rates, certificates of deposit, where there's trillions of dollars currently owned by mostly baby boomers, I would probably argue, Are you fairly satisfied with the rate you're getting on your certificate of deposit or that savings account, 10 basis points? When they say no, what does that open up the conversation for by merely broaching that conversation? Or, they have $500,000 in securities. Are you fairly satisfied with the performance as of recently of your securities portfolio? Nobody on earth is going to say that they're satisfied, right? And that is when you open up the conversation to what we're about to talk about here. Any questions? Chat away here if you have any questions, and I'll answer them. And ask questions as we go. I will answer them in real time, unless it's something crazy. I don't ignore any questions. David, any questions coming in on your end? Then we're going to get into commission. Somebody asked this question, I think is on LinkedIn, just generic commission levels.
Yeah, and he's joined us. Let's see. The only thing I've gotten in is that Richard Kofin. He's joining us on LinkedIn. He said that annuities can be a bond alternative, although he misspelled it, but no big deal. And then Armando Paz, good friend of mine out
What
in
a
Florida.
perfectionist you are.
Yeah, well, I'm that way. Armando's added that he thought that the average age of an agent was 57. I was going to be real smart and say my biggest competitor is age 45. He's me, and I got to compete against myself. So that was my mentality getting off topic there. But otherwise, no, I don't have any other questions or anything else that's come in so far.
Great. That is a good point. The bond alternative, absolutely. It's not a stock market alternative. Indexed annuities are not a stock. I guess annuities can be an alternative for anything, but is it designed to keep up with certain things? Not the stock market, that is. Yes, and our biggest competitor is ourselves, which brings me to the point, when you ask those questions, how satisfied are you with your certificate of deposit rate? How satisfied are you with, what your stock market what your brokerage accounts have done? Shut up and listen, right? Shut up and listen. We always want to talk. And me as well, I get going on this stuff. I love this stuff and I just want to keep talking. So therefore me, Charlie, shut up and just listen. Because a lot of times if you just keep your mouth shut, I've had meetings before where I felt like I didn't say anything. I didn't give them all the wisdom that I had. None of the wisdom I had. I'm being facetious. I walk out and I'll get a message the next day. That was a great meeting. I really got a lot out of this. I didn't say anything. I just listened. That's all I did. There's a story. I'll tell you a quick a story here. So going into the doctor, getting checked out in various areas. Athletics have been a little bit brutal on me, but as the doctor's checking me out, he says, or I say to him, like, doctor, maybe you can help me out with my wife as well. He says, what's the issue? I say, well, I think she's losing her hearing. She just doesn't hear what I say. She doesn't hear what anybody says. I don't know what's going on, but it seems to be happening at a pretty rapid clip here. The doctor says, hey, those audiologists, they'll just waste your money. I'm going to give you a homemade audiology exam here. Here's what you do is you go home, and when she's got her back to you, you say something to her. And if she can't hear you, get a little closer. You say something again. If she can't hear you, get a little closer. You say it again. And finally, you'll be able, when she does hear you, you will be able to gauge just how severe her hearing loss is. Like, all right, that's beautiful. So I go home, my wife's chopping away at the counter, dinner, whatever she's cooking over there. And I go across the room, I say, honey, what's for dinner? Nothing. Right? She can't see me talking. She's got her back to me. So I get a little closer. Honey, what's for dinner? Still doesn't hear me. Like, man, this is bad. Get a little closer. Honey, what's for dinner? Nothing. Finally, I'm right behind her and I'm yelling, honey, what is for dinner? She turns around, looks at me, and damn it, Charlie. For the fourth time, I told you we are having steak. Whose hearing issue was it? It was my hearing issue, right? A lot of times it is ourselves preventing ourselves to bring up the conversation that they want to hear, that the consumers want to hear. But it's ourselves. We are our own worst enemy here. So somebody asked the question, hey, so Charlie, when you talk about making a ton of money when it comes to annuities, what do you mean by that? What are the commission levels? First of all, I wasn't talking about the commission levels. I can make 0.5%. And if you're helping enough people, you can make millions of dollars, right? To exaggerate. So the need is there. I think I've explained the need is there, but I'll tell you, so $150,000 cases, that is kind of the average, at least with my company. And I'm sure my friend Cheryl Moore over at Wink would tell you that that's probably in line with the industry. A large chunk of that is indexed annuities. And Cheryl would also tell you that the average commission on an indexed annuity is over 6%. So if you're a life only agent or a long-term care only agent, well, you would be a life agent, certainly probably if you're a part of this group. And if you're like, are annuities very lucrative? Yeah, they're lucrative to the client and lucrative to you. When you look at that average case, $9,000, you do a couple of those in a day and that should get you by, right? So the opportunity is big. The baby boom generation is big. They own 60% of the wealth. You must bring up just bring up a question, and that will take you to this next phase here.
Now, Charlie, I'm going to interrupt you real quick because I got this question that came in. Armando asked, what is the best reply when people say that commissions on annuities are why they're not a good investment? What are your thoughts on that?
Yeah. First of all, yes, I do get paid commission. I always love that when, people are judged by, XYZ is driving a $100,000 Escalade. He must make too much. I want my financial professional to make a lot of money. If he pulls up in a Pinto, it's a double-edged sword. I would question if he is worthy of my business. But the response is yes, I do get paid a commission. Now the commission is paid not from you, but from the insurance carrier to me. And yes, that is priced over because then, somebody that knows the pricing in an annuity is going to say, yeah, Charlie, that's a CAN BS line. We all know that commission that you get is priced into the annuity. Absolutely it is. But I'll tell you, if you take a 10-year annuity, what's the average? You know this, David. What is the average AUM fee in the industry? So talking securities, not annuities. The AUM fee that a client's going to be charged every year.
Typically to the advisor without regard to the other fees that may be in there. We'll just say 1%.
1%. Yeah, that's the average that I know about. And that's probably my average is I'm a little less than that. So you really have two different choices. One is you could go with your advisor, you could stick with the advisor who, not including the fund expenses, the ETF expenses, whatever you're in, and you're looking at what, 10% over 10 years? I'll tell you that of the $40 million that has come through my business over the last year, there's not one product that came through that paid anybody 10% on a 10-year chassis. So that's a little more of an analytical response. I mean, the cookie cutter, as I've heard a lot of agents say, is, ma'am, you're not paid commission. I'm not paid commission from you. That's what the insurance company gives me. So that's my response there. Fortunately, I believe that if you do a good enough job with this other stuff, I mean, yes, it'll come up. At one point in our career, it'll come up. But I just don't run into that a whole lot. And I personally do a few million a year in annuity production. I don't have a client say, tell me what you make, Charlie. Now, will it come up? It will. But if you do a really good job, I just don't think that is usually the elephant in the room. Am I right or am I right, Dave?
I would have to agree with that because if the appointment is going well, I want them to judge me by the output I'm going to guarantee, not necessarily the income I'm going to get. So, I mean, I want to be able to also say, if this was 100% commission to me, judge me by the outcome I can deliver for you. As long as this is delivered, does it matter what my compensation is? It shouldn't.
Yeah. I have had, so here is some I dealt with just 2 weeks ago. The opposite of this. This lady attended one of my Social Security seminars, and as the conversation progressed, she had like $50,000 in an Invesco fund, A shares. It's pretty easy to switch me over as the advisor to where I don't get paid a commission or anything. I just get paid the small 12B1 fees when I'm switched over as the advisor, and it's easy switch. But 50 grand, whatever the 12B1 fee, I don't know what, 25 basis points. I don't even know. It's almost not worth it to me. But she said, well, you've done a great job. Can I make you can we move it to you? You know, that's what can we move this over to you? Well, it's not moving it anywhere. It's just switching me over as the advisor. And I said, I'd be more than happy to help you, even though I'm not going to get my time's worth out of it. But I serve the people. I'm more than happy to help you. I said, I'm not going to get any commission or anything. There's a little fee that I'll get, you know, called 12B1s, you know, so kind of the opposite. She goes, so is it even going to be worth your time? Yeah. You know, so she was hoping that I got paid more. Well, I can always move you over to something else, I told her, but that's not what's in your best interest. So shouldn't come up a whole lot if, yeah, you're doing a lot.
But that's the sign of a great client, someone that wants to know, is this even worth your time? And just for someone asking that, it's automatically worth my time, even if the compensation's so low.
Absolutely.
But I want that kind of client. So yeah, anyway, just my thoughts.
So you asked the question, right? You know, how satisfied are you with the rates that you're currently getting? How satisfied are you with the performance that your XYZ broker has done for you on your accounts? They're not going to be satisfied. And that's where you drill down into what I talk about, the risk spectrum. And we all know this, I know, but you know, you have two different sides of the spectrum. You have your certificates of deposit, which I'll already know by that point where their money is, right? You'll have your certificates of deposit, you know, the conservative side, of course, but there is no free lunch. If you want the upside, then you have equities, you have real estate, you know, ETFs, your mutual funds, your American funds, and whatever you could categorize on the aggressive side of the spectrum. And Mrs. Client, really, where is it? I take it that you are on the conservative side because you have a couple $100,000 in a certificate of deposit. And by the way, I can get you today's numbers. I can get you a 5.5% 3-year rate, Mrs. Client. Now, obviously, if she's getting 6% a certificate of deposit, you know, that's going to fall on deaf ears. But I guess I haven't really seen that when I'm competing against certificate of deposit. I can get you 5.5% for 3 years, 5.5% for 5 years. I can get you 4.4% in 1 year. So if that is the box that you feel comfortable in, we can, if you like, we can talk more about this. And by the way, that 1099 love letter that the bank sends out to you every year, that's not going to come to you with this. Or I will segue then, if you go a little further to the right on my spectrum, if you don't mind, Mrs. Client, I want to draw you just kind of a quick diagram to demonstrate something that may be of interest for you. It's not going to guarantee you a set rate, but history has shown that it will beat the bank. It's not guaranteed to beat the bank, but it's designed to beat the bank. So Mrs. Client, can I show you this diagram? And of course, are they going to say, no, you can't? You know, all right, well, I'm going to show you the diagram here. So what this is called is it's an indexed annuity. I'm not a big fan of don't tell them it's an annuity. Tell them, you know, what it does, and then never bring up annuity because that's a bad word. I disclose it up front. If it's life insurance I'm talking about, I'll tell them life insurance, but nothing wrong with the other way. It's just, I guess it's just not my style. So Mrs. Client, here is how an indexed annuity works, just in generic terms here. So let's say you have the stock market. I'm going to bring my mic over here. So you have the stock market, and let's say the stock market 1 year drops 20%. So negative 20% there. I'm going to draw a little bigger here so you can see it. But in the next year, the market goes up. It goes up, let's say 25%. And this is verbatim my diagram when I'm talking about accumulation, right? How their money is credited, because there are two phases to annuities. There are two different phases, and you have to know these diagrams. In my opinion, you have to know these diagrams for the accumulation phase and the distribution phase. And I'm going to show you both the diagrams that I used. I'm also going to tell you how the watch is built. So let's say the market goes up the next year, positive 25%. How much higher are we from where we started in your stock or mutual fund or whatever, not including fees? Negative 20, positive 25. We're merely back to where we started, right? Now, of course, this is just an example here, but the example, this part of the example actually played out last year. I'm not saying this year it's going to increase, but how would this indexed annuity work in this type of environment? I'll take one indexed annuity, for example, for compliance reasons. I won't tell anybody the company yet. By the way, you can always contact me offline. I can share any of this with you. I have hundreds of articles, videos, all that stuff I can share with you. All right, well, how would our indexed annuity have done in the year where the market lost 20%? Well, you would have gotten a goose egg, a zero on your statement. No, there are no fees in indexed annuities. Dave Ramsey and Susie Orman don't know what they're talking about. They actually do. It's just that they generalize. Oh, 3%, 4% fees. No, the typical indexed annuity has zero fees unless you're attaching some sort of a GLWB rider, for example, which we'll talk about here in a bit. Your $100,000 at the beginning is $100,000 later on. Well, then when the market went up 25%, what did you get? This annuity that I'm going to talk with you about, Mrs. Client, has a 10% cap, a 10% cap. What does that mean? And it's the S&P 500. That's the index. It's the S&P 500. Nothing fancy. There are volatility control strategies out there, which I can talk about, and the difference between vol control and the straight S&P, but a 10% cap. So if that S&P 500 goes up at least 10% in that following year, what does the client get? Well, yeah, it went up 25%. So what does our client get? They get 10%. So from the point that you put in your $100,000 to 2 years later, you now have $110,000. Now, is that crazy good? I would argue it is, considering that our market here, for example, is merely back to where it started. I would consider 10% over 2 years with interest rates where they were, at least prior to this last year, very, very good, right? That's 4 point whatever per year with compounding. Call it 5% per year simple, right? And this is the part that I learned to throw in there. I just threw this in once on accident. And I've since done that because I saw the reaction from the clients like, whoa, really? And it's just this, just one day I said, well, and by the way, if the market drops back down, you know, in that following year, in that third year, what happens to your $110,000? They're like, well, I assume I lose the interest, what's been credited. No, not only do you not lose your principal, but you don't lose the interest that was credited previously. And for some reason, that last part seems to, yeah, you know, it's like I get used to my stories here and I tend to think I know what clients are interested in, but sometimes out of left field, they love that part. You not only keep your principal, but you keep the interest that was previously credited. In other words, Mrs. Client, indexed annuities, it's not about the amount of return on your money. It's not about getting 25%. They're not going to do 25%. It's not about the amount of return on your money. It's about, David, the amount of money you're getting the return on, as David talked about. And that is what enables indexed annuities to sometimes perform really, really good relative to the bank, sometimes relative to the stock market, but that's not language you're going to hear come out of my mouth in a client meeting. Now, when I get to that point, the skeptical clients, what do they say? What do they say many times at that point in time? What I just explained, it was nothing they've ever heard of. What do you think the statement is next?
Is that too
David,
good to be true? How does that work? It's one of the two.
Yeah. What is this, like a Ponzi scheme? Seems too good to be true. You know, how is it that the company's able to do this?
And I immediately say yes. Wouldn't
Yeah,
you like
you're
to get in on my scheme here? But anyway,
yeah. Hey, as long as I'm on the front end of that Ponzi scheme, then no. My broker dealer would not like to hear that. Okay,
yeah,
well,
let's not say we didn't. Okay.
yeah. So this is where I will explain to you guys and gals how the watch is built. Now, I have my ways of paraphrasing it down to the clients. Well, you know, the carriers, instead of just giving you a fixed rate, you know, they have the ability to take that otherwise interest credit and invest it in options that give you that upside kick. So should the market go up, that carrier has taken your 5% on $100,000, has taken your $5,000 And instead of just giving that to you, they're able to invest in these things called options, call options. And that's what gives it the upside kick. But always, 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 your premium is protected. Unless you cash the policy out early, then you have surrender charges. So that's kind of a way that I paraphrase it a lot of times, but let's get a little more into it than that for you fine folks. So a client gives the insurance company $100,000. Folks, you tell me. You tell me. By the way, Jeff, I like that. I want to earn your business can help. Yeah, so talking about the language, some of the questions, I think that comment goes back to when I was talking about questions. Agree with David. The outcome is what matters. Yes, I like that. It's not about what I have as income. It's about your outcome. I like that a lot. Never heard that from you, David. That's very good.
This is what happens when we have dialogue in a webinar instead of just doing a monologue from you, Charlie. So I have more fun with it that way.
I do as well. And believe me, I'm probably a pretty boring person if it's just an hour-long monologue. So, folks, where does most of our clients' $100,000 go? Tell me in the comment or in the chat box there. Where does most of that carrier's money go, or the client's money go, when the carrier takes that $100,000? What does that carrier put that money into? What does that carrier invest the money into if we're talking an annuity? Whether it's a fixed annuity or an indexed annuity, heck, or a life insurance policy. We can get into IUL versus fixed index annuities all day long because there are differences there, but not really differences when it comes to this. That's right, bonds. So the carrier goes out, they say, okay, we have, let's call it 95,000. So almost all of it. So 95,000. And we are going to invest in bonds. That client gave us 100,000. Thank you very much. We'll take 95 grand to oversimplify, and we're going to invest in bonds. What's the carrier getting on that bond rate? Oh, well, the 10-year treasury is at, a little less than 4%. I use the Moody's BAA bond yield. That's a better benchmark. That tells you kind of what carriers are getting, because it's not the highest of investment grade. Carriers are reaching for yield and going a little lower. The Moody's BAA bond yield, let's just say their bonds are going to generate, say, 6% income on almost our $95,000. We're going to come back to this in a bit. Folks, what did the carrier do? And yes, and this 95,000, the bonds that they purchased, that is a part of the carrier's general account, right? It's part of the carrier's general account. This is how insurance companies work. But what does the carrier do with that other $5,000? And this is simplified, of course, but that other $5,000, what does the carrier do with that? This is the upside potential. This is the rocket booster effect, not compliance approved, but you guys can put it your own. This is what gives us that upside kick, right? This is the call options. So the carrier goes out to whoever, BNP Paribas, Goldman Sachs, and says, hey, I have $100,000 here, notional value, but I want to pay you $5,000 because that is my call option budget. I want to pay you $5,000, Goldman Sachs. How much upside in the S&P 500, in our example, just an S&P 500, how much upside can you give us? It's more technical than that. There are options that are bought and sold and all that, but I'm paraphrasing this. How much upside can you give us? BNP Paribas comes back and says, we'll give you everything that the market does up to 10%. The insurance company says, okay, so our $5,000 will give us upside of upside on this entire notional value, $100,000 of 10%. BNP Paribas says, yes, that's correct. But BNP Paribas also says, but if the market doesn't go up, you, carrier, have bought a call option that over the next year, it's going to be worthwhile or worthless. So what happens if the market doesn't go up over that 1 year period of time? Folks, what happens to our $5,000 there? David, what happens to our carrier's $5,000 if at the end of the year, the market did nothing?
So if we're out of the money, that means the call expires worthless.
That is either worthwhile or worthless. The carrier lost that $5,000 bet. Now, what really happened at the policy level? And by the way, that 10% that Goldman Sachs told us, the carrier, that they had, that is put into the contract. And what is that called? What's that called to the client? That's called a cap. So it is indirectly Goldman Sachs, it is indirectly the cost of call options that determine how high the cap is on the client's money, as well as the size of the call option budget, right? Mm-hmm. And this is IUL as well, folks. So some of the more astute folks on the phone, more astute than me or whatever, may be thinking, well, but if you lose that $5,000, what does a carrier do that following year? How do they get that $5,000? Let's come back over to our 6%. The carriers make their money, whether it's IUL or annuities. Actually, IUL, there's not much spread in it with carriers, but certainly indexed annuities. How do carriers make their money? Off a spread. So the carrier may shave 1% off the top of that 6%. That 6% is coming in every year, right? $6,000, so to speak, every year. The carrier might shave 1% off the top. Well, there's still 5% left over after the carrier takes their cut every year, right? What does that 5% go to? Year 2, year 3, year 4, the call option budget. That is the call option budget. What I just explained here is how indexed annuities are built versus with a fixed annuity, with just a multi-year guaranteed fixed annuity. What happens to that 5% every year? It doesn't go to buy call options. Where does that 5% go? Any idea, David?
It goes right into the contract.
Boom, right over to the client. So it's really not that complicated of an idea, right? So Keyport back in the day said, let's see, so we can give 5% every year to the client or whatever the rates were at the time, or we can take that 5% and we could go over here and we could buy call options. That will give it more upside potential than just the 5% that we could otherwise give our clients. Boom, that's indexed annuities right there. Now, what makes caps increase or decrease? The call of options, number one. Mm-hmm. So let's say that call options went up in price. And for that same 10% cap, Goldman Sachs says that would take $6,000 the following year. But we only have $5,000. What do you think would happen to the renewal cap in that year? It's going to decrease because we only have $5,000. Goldman Sachs may come back and say, well, then 8% is your cap. So the actual budget, which is determined off interest rates, as well as the cost of options, is what makes caps increase and decrease. That's how the watch is built. Did I miss anything there, David?
No, pretty good. I've got another thing to bring up, but Armando just asked, and I'll show this on the screen that you won't see, but do they buy ITM or OTM? I think that's in the market or off or over the, I'm thinking over the counter. I don't know all the acronyms that everybody uses. Do they buy ITM or OTM call options, or do they sell puts, ITM, OTM? I think it's in the money, out of the money.
In the money and out of the money. So, and folks, I have a long article on this. I want to say, I looked at it this morning, like 4,000 advisors have viewed this. All of this, but technically what happens with the call options, because again, I'm simplifying this. Technically what's happened is the carrier is buying an at-the-money call option. So based off of where the S&P 500 is today, and they're selling an out-of-the-money call option at a price, an out-of-the-money call option, and how much out of the money that call option is depends on how much of an option budget that carrier has. That probably doesn't make sense to a whole lot of folks, but that is called a vertical call spread, is what that is called. But if you want a simplified way of really understanding the option strategy, people, well, why wouldn't I replicate the option strategy? Charlie, you tell us how to do it in this article here that you wrote. Why wouldn't I replicate that option strategy? Couple reasons. Number one is carrier tax advantages within an insurance wrapper, right? You can't replicate that with buying and selling your own call options. Not legally, I don't think. And the second reason is quantity. Carriers are dealing with these things, hundreds and thousands of these. So
and institutional purchasing power in that. One thing I was going to bring up is that because I came originally from the broker-dealer world and we sold variable annuities, and learning about market value adjustments, that whole explanation you gave, and of course you just wiped your whiteboard clean just there, but that helps explain why there's market value adjustments if you surrender the thing, because variable annuities don't do that, because they're invested in mutual fund sub-accounts. They're not investing in the general investment account with all the bonds and everything, where you're pricing in the index options and such. And that's why there's market value adjustments on index annuities and other similar contracts that there are not in variable annuities. So I wanted to bring that up.
Very well said. Because almost all the client's money is going into bonds down here, if you remember right. What is the saying with bonds? If you're in a bond and if interest rates increase, what happens to the value of your bond? It drops, right? Your bond is not, if rates go from 6% to 8%, your 6% bond is not as sexy as what's being currently offered. So therefore, market forces tell us that the bond value, right, is going to decrease. So that's that inverse relationship. So when your client comes to you today, which is happening a lot, folks, this is something that you will see if you're in the annuity business. I just wrote an article on this yesterday. So I got this last week, Charlie. So my clients are saying they want to cash out their old annuity because new annuities, because of higher interest rates, are giving much higher caps as well as participation rates. Can my client do this? Well, so what's happening if the client does do that? That carrier is cashing out their bonds, right? They're cashing out the bonds in order to give that back to the money. Well, what has happened with those bonds that the carrier is cashing out? They've decreased. So what is a mechanism that carriers have, and rightfully so, to pass on that bond loss to the clients? That is called a market value adjustment, which is an additional surrender charge. It's an additional surrender charge. So an agent called me last week, said, can I do this? I'm like, what's the MVA? Says, I don't know. I said, well, the reason that caps are so high today relative to when this one was issued, or the renewal cap on it, is because rates have increased. So I bet if you go back and look at this one, you're going to have a very negative market value adjustment. It's a great point on that. So MVAs, be aware of MVAs because they're out there. They're not a bad thing. They're just a necessary thing.
Right.
All right. So this is, and then we're going to be off here in like.
Oh, and by the way, when someone's complaining about the current caps or whatever else, if they're in an index annuity, theirs will renew at a better rate once it comes for renewal. That's an interesting thing I'm finding. A lot of producers, they look at the rates that the IMOs are sending them and say, hey, that's the greatest thing. Your existing contracts will and should be adjusting upon the segment renewal, whenever that is, whether it's a 1 year or 2 year, it should renew better. I wouldn't be chasing the shiny object, because if you're already there, no reason to move out and find something else. It's probably not the best interest for the client once you factor in all the costs involved.
Well, but here's what happens. So annuity pricing is a little different than life insurance pricing, right? Because for the most part, that 6%, as interest rates increase, that 6% call option budget, technically it was 5%, my example.
Yep.
That is fairly locked in for the duration of the annuity. While new issues where carriers are going out, but you're talking life insurance, that is the general account pricing with life insurance, you will find that an IUL product of the same generation, the new money versus renewals are going to be about the same. With annuities, So this situation last week, David, was somebody came to me and said, hey, 300% participation rates on a new annuity. My client on the exact same annuity is getting a renewal of 185%. Is a carrier trying to rip my client off? No, it's just that carrier on that chunk of money was locked in to that 6%, to where today that option budget may be 8. It's not 8%, but rhetorically, let's say 8% or whatever.
Mm-hmm. Okay.
Folks, GLWBs are the best thing since sliced bread, a guaranteed lifetime withdrawal. So this is the second phase we're going into. So the clients that want a Social Security supplement, the clients that are concerned with, man, what if I run out of money? I want permission to spend my money. GLWBs. Now, I'm going to make a comparison here to set kind of just level set here. Then we're going to talk about GLWBs. Here's a conversation that I have with consumers. Like, okay, so you have your $100,000 and you're 63 years of age. You want to retire 2 years from now at age 65, and your stocks, bonds, whatever. Let me ask you a question. If all goes well between now and 2 years from now, what would you hope? What would you be happy with? What would you be satisfied with? Not too aggressive, not too conservative. What would be a not too aggressive, not too conservative rate of return? Hundreds of seminar rooms across the country. I've heard usually it's 5%, 6%. I wouldn't balk if it did 5% per year, 6% per year. Doesn't matter. I could plug in 15% per year and my end point's going to be the same. So let's say 5%. So 110,000 over 2 years. That's hoping and praying that the market doesn't do what it did last year, right? Hoping and praying. Well, all comes true at that point in time. Well, at that point in time, you want to take withdrawals from your portfolio, Mrs. Client. How much? What's the rule of thumb? What's the old rule of thumb? David, you're thinking the old one or the new one, right?
Which one is it now?
Yeah. If they say 8%, not 9% per year. I've never had that happen, but you need to educate them. Well, the old rule of thumb is 4%, right? So 0.04%. William Bingen, 1994. It's been updated to a lot less than 4%, but let's be generous to the situation here. So what that means is crossing our fingers, that comes true there, 100 to 110. And then crossing our fingers that the 4% is sustainable for your 30-year retirement. That's $4,400 that you can withdraw, hoping and praying and having everything come true here, right? Now, there's some pundits out there, oh, you should not compare GLWBs to the 4% rule of thumb because the 4% rule of thumb incorporated inflation. I get that. And I talk about that every time. So technically, the 4% rule says, but then when inflation goes up 3% or whatever, you have to increase it by that. So that's the first year of retirement. I'm going to talk about inflation here in a bit. What if I told you to forget about all this, forget about the hoping and praying? What if I told you that from an income standpoint, here's just a sample product, an example product. From an income standpoint, your $100,000 is going to go to $120,000. From an income value standpoint, what your income is ultimately based off of, 10% simple per year. But then at that point in time, and this is guaranteed, no hoping, no praying, at that point in time, you get to take out X% of that value forever and ever and ever. Regardless of how your money, if you run out of money, it doesn't matter. This end payment is going to come forever and ever and ever. So how much, Mrs. Client, do you think it is that you can withdraw from at that point in time? 4%? No, I'm talking about something completely different. In this case, it is 6.5%. 6.5% guaranteed. So you multiply the two of those, that's $7,800 guaranteed for the rest of your life. That once you turn 65, 2 years from now, you trigger that income, you're guaranteed. What is that? Is that like 80% more in income for the rest of your life? No ifs, ands, or buts. Even if the market performs poorly, you're going to get that forever. Well, but that doesn't include inflation. That's correct. It doesn't include inflation. But if you look at the cumulative withdrawals the 4% rule with 3% inflation versus this on out for 50 years, that crossover point does not happen until you're 27. And that doesn't even take into consideration the time value of money of getting a higher payment earlier, right? Yep. I could really drill into the numbers, and that would push that crossover point even further out. That is the GLWB conversation right there. Well, but Susie Orman and Dave Ramsey say that once you annuitize, you lose all control. This is not annuitization, because your underlying value is, well, not losing money, but it's going up, maybe not 10%, but that underlying value, should you die early, goes to your beneficiaries. There's a difference between annuitization and guaranteed lifetime withdrawal benefits. And I'll end with this. How is that possible? How is that possible? Moshe Milevsky, Tom Hagna. How is it possible? Because it's an insurance company, because of something called pooling. The same question was asked when life insurance was created a few hundred years ago, right? I pay a premium today, tomorrow I get hit by a bus, my beneficiaries get a gazillion bucks. Seems too good to be true. Mrs. Client, I'll tell you this quick story. Bear with me here for a second. So this is me talking to the client, right? Bear with me for a second. So there are 5 95-year-olds are sitting around the table playing bingo. They've been doing this for 30 years. They're bored. One looks to the others and says, this sucks. Let's do something different. Let's each throw $100 on the table. Each throw $100 on the table. And whoever is around a year from now, we'll split the pot. The others say, that's cool, let's do that. So a year goes by, and the mortality tables tell us how many 96-year-olds will still be around. 4 of them. So they split the pot. Quick math here. What is that? That's $125, right? So those 4 split the pot. It's $125. Isn't that, they didn't even invest that money like the insurance company did. They got $125. That is mortality credits right there that I just explained. And that is how insurance companies do it, spread across millions of people. Now, I'm not suggesting that GLWBs are going to give them 25%. I'm just saying that that extra 1% or so that many writers cost, that is what that 1% GLWB fee is going to, so that ultimately, if they're in the scenario that lives to be 100, others that died before them are paying for their longevity. And that, folks, is longevity insurance. That's GLWBs. That's how the watch is built, and that's how the indexing, how I explain that to clients. David, I'm done here. Did I miss anything?
No, I think you covered a lot of good stuff there. I can't think of anything else on top of my head here, at least at this point. And comments are, we've covered all of these so thus far. This is your time to ask any other questions, guys. So throw them into the chat. I'm watching on all social media and everything. But
what does everybody think? I'm curious. This is different than life insurance. I'm curious what everybody thinks about just this type of stuff, I guess.
By the way, adjust your mic a little bit there, Charlie. You get slightly out
behind me. Because it's behind me. No, David, again, I really appreciate the opportunity, and thanks, folks, for all those that tuned in. If there are no questions, well, let me know if there are questions coming through.
Here we go. How do you answer variable annuity? I don't know the question.
Yeah.
So, Eliza, give us some more here. Or
appreciate
Elisa.
Eliza, Eliza.
I'm sorry.
Well, variable annuities is a bit of a different can of worms. There are additional fees and stuff. And but yeah, fixed annuities are now 2/3 of the overall annuity world. So that, the worm is turned, so to speak.
Yeah. I mean, I sold them back, from 05 to 07 and such, back when in the heyday of variable annuities, and they were great value at the time. Then 2008 happened.
Yep.
And carriers realized that they didn't quite price them the right way. And they've been repriced since then. So, okay. She expanded. Clients ask all the time now, since variables are guaranteeing 6%. Must be talking about a lifetime benefit rider there.
Well, and by the way, what I just explained with the 10%, This is probably the number one area of misrepresentation, Elisa or Alyssa, not just with variable annuities, but with GLWBs as well. Because what I just explained, oh, you're guaranteed 10% per year. You're not. That is your withdrawal base. Here is how I explain this. And this is the same with variable annuities. Variable annuities, you have your contract value that will go up and down, but you also have many of these GLWB riders that are like 6% per year, 7% or whatever. I found that annuities generally have more lucrative GLWBs, but mine's 10%. How do I explain this value guaranteed to go up versus the client's actual value? Here's how I explain it. Mrs. Client, it's a lot like permanent cash value life insurance, whole life insurance. You have your value, your cash value in your whole life insurance, right? That is your money. You can cash that out. You can walk away. You can do whatever you want with it. But then there's that second value that is usually, well, always on life insurance, a larger value. What is that second value? What's that second value I'm referring to, David?
You're talking about a death benefit.
The death benefit. Now, with the death benefit, there are certain requirements that are required for somebody to get that death benefit, that higher value. What is that requirement? Well, it's not very fun. You have to die or a chronic illness or whatever. So this is the same concept. You have your value, which on an indexed annuity will only go up outside of rider fees, by the way, 1% call, will only go up. If you die, that goes to the beneficiary. But that second value, the carrier just requires you to not take it, to get that second value or get your income based off that second value, to not take any more than X% per year of that second value, 6.5%, my example. So that's it. Carriers have the requirement with life insurance. Carriers have a requirement with the benefit base. But just know, Mrs. Client, that 6% or 10% value is not like you can just take it and cash it out. Your true money with VAs are looking like that.
Yeah, absolutely. And even with variable annuity GMIBs, GMWBs, and EIOUBs, but whatever they're called. I mean, but they're very different now in terms of the costs of variable annuities than they used to be. And I remember, and since this is an old expired product, I'm sure I could talk about it. MetLife had what I called the 666. You probably don't like that term, but but it was a 6% bonus, 6% step up until you take out withdrawals, and then it was 6% a year. And that's a fantastic contract. I hope everybody that ever sold one still has it. But it's still based on the claims paying ability of the company, and MetLife in a way is kind of, they've rebranded. But it's still the residual values to remaining beneficiaries will be based on whatever the market has done in those sub accounts. Whereas with the indexed annuities, you have it's principal protected, at least in terms of until the money's all withdrawn out, because you get paid your money first, then it's the insurance company's money later. So.
Yeah. And I'll tell you, with the caps, so the client's underlying value, right? Not the benefit base, but the client's underlying value. Say like one carrier, 9% caps that you can get from a accumulation value standpoint. Anybody that says, oh, I want to go to a variable annuity because I think that has better upside potential, 9%, really? The variable annuity after fees has to do 13% to get equivalent to the indexed annuities 9%. So it is getting hard with the interest rates increasing and really helping indexed annuities. It's getting very hard for some of the variable annuities to argue against indexed annuities. Another thing is actuarially, really simple, actuarially, the reason indexed annuities can generally provide higher GLWB guarantees, like that 7,800 guaranteed, period. Today, Mrs. Client, I can guarantee you that for the rest of your life, once you retire at 65, 7,800, period. That 7,800 is easier on indexed annuities. Why is that? Because with variable annuities, if you're guaranteeing this on the benefit base, but if the contract value does this, The difference between the two is what the carrier has to make up for, right? That's a net amount of, think of net amount at risk. That's a lot of risk to the carrier. With indexed annuities, can the client lose their own value? No. This is less of a risk to the carrier than this, right? And that's where indexed annuities have kind of a natural hedge. Another natural hedge is, what if everybody lives forever, Charlie? Your annuity companies are going to go out of business. If everybody lives forever, they're going to go out of business. No, because what's a natural hedge on the other side of that company's mortality profile? Life insurance. Insurance companies are a beautiful thing because of the pooling and because that counterbalance that is life insurance. If everybody lives forever, that's good for the life insurance company, just not good for the annuity company. If they both offer the same, it balances out.
Yep. Perfect. Absolutely. All right, guys. Nothing else has really come in here, but guys, check out Charlie's website, cgfinancialgroupllc.com. Get on his email list. He does webinars. Actually, he probably canceled one. He probably scheduled for today to be on this one. We usually do a webinar about every week, every other week on Thursdays at this time. You go through a lot of details in a lot of your webinars. You did one on taxes that kind of threw me a couple of loops there. And but anyway, get on his email newsletter list. Just get clued in, and wherever Charlie can fit in for your business, I'm pretty sure it'd be welcomed. And that's part of one of the reasons why we do this. I like showing you who I do business with and why. You get to check them out and find out for yourself. So anyway, we're going to leave it at that, guys, unless there's anything else last second. Eliza, thank you very much. Or at least, forgive me. I'll get it right later. Okay. But anyway, we'll leave it at that. Thank you all so much, Charlie. Thank you for your time. This was great. And we'll see you all back in the Facebook group.
Thank you, everybody. Appreciate it.